A metal most people have never thought about just doubled in price in 90 days. Not Bitcoin, not silver, not gold, tungsten. And the reason it doubled is not speculation. It is not a viral post. It is not a Reddit thread or a hedge fund squeeze. The reason tungsten doubled is because China decided to restrict exports. One policy decision, one country, 90 days, 100% gain. And if you think this is just a tungsten story, you are missing the entire point. Because what just happened to tungsten is a blueprint. It is a live demonstration of what happens when the world's dominant supplier of a critical material decides that domestic security matters more than global supply. And tungsten is not the last metal this will happen to. It might be the first. Hello everyone, Ken AG here. Today we are going to break down exactly what happened with tungsten, why it matters far beyond the tungsten market itself, and what it signals for silver, gold, copper, and the entire critical minerals complex. By the end of this video, you are going to understand a framework that most retail investors never consider. A framework that separates people who react to price, moves from people who anticipate them. Because the tungsten story is not really about tungsten. It is about a regime change in how the world sources, secures, and prices strategic materials. And that regime change has implications for every metal you own or are thinking about owning. Quick disclaimer before we get into it. This content is educational and informational. It is not financial advice. I am not recommending that you buy or sell any asset. Markets are volatile. Risk is real. And everyone should make their own decisions based on their own situation and their own research. Now, let us get to work. To understand why tungsten doubling matters, you first need to understand what tungsten is and why it occupies a unique position in the global economy. Tungsten has the highest melting point of any metal on the periodic table. It is extraordinarily dense. It is extraordinarily hard. And those properties make it irreplaceable in applications where failure is not an option. Armor-piercing ammunition, missile guidance systems, satellite components, drilling equipment for oil and gas, cutting tools for advanced manufacturing, radiation shielding in medical and nuclear applications, semiconductor fabrication equipment, aerospace turbine blades. The list goes on. And the critical word in that list is irreplaceable. This is not a metal where you can easily substitute something cheaper when the price goes up. The physics do not allow it. There is no other element that combines tungsten's density, hardness, and thermal resistance. When you need tungsten, you need tungsten. Now here is where the story gets uncomfortable. China controls approximately 80% of global tungsten production. Not 40%, not 60%, 80%. That is a concentration of supply that would make OPEC blush. And it is not just raw mining. China dominates the entire value chain. Mining, processing, refining, intermediate product manufacturing. The tungsten powder that goes into cutting tools, the tungsten carbide that goes into drill bits, the tungsten alloys that go into military applications, almost all of it traces back to Chinese processing facilities at some point in the chain. And for decades, the world was perfectly comfortable with this arrangement. Tungsten was cheap. Supply was abundant. Chinese producers competed aggressively on price, often selling below what Western producers could match. Western manufacturers built their entire supply chains around the assumption that Chinese tungsten would always be available, always be affordable, and always flow freely across borders. They closed domestic mines because they could not compete on cost. They shuttered processing facilities because it was cheaper to import. They outsourced the entire supply chain to a single country and called it efficiency. That assumption just died. And it did not die quietly. It died at 100% in 90 days. When China announced restrictions on tungsten exports, the market did not have time to adjust gracefully. There was no gradual tightening. There was no slow squeeze. The price moved violently because the market suddenly had to reprice a reality it had been ignoring for years. The reality that 80% supply concentration in a single country is not efficiency. It is dependency, and dependency only works as long as the supplier cooperates. The moment the supplier decides to prioritize domestic consumption, the moment geopolitical tensions make cooperation less attractive, the moment national security calculus shifts, the dependency becomes a trap. and the price is the messenger that tells you the trap has been sprung. Let me walk you through the mechanics of what happened, because the speed of the move tells you something important about the structure of the market. In a well-diversified commodity market, with multiple large producers spread across different geographies, an export restriction from one country creates stress, but not chaos. Other producers ramp up. Alternative sources get activated. The market adjusts over weeks or months with moderate price increases. But in a market where one country controls 80% of supply, there is no meaningful alternative to activate. Western tungsten production is minimal. Recycling capacity is limited. New mines take years, sometimes a decade, to bring online. Environmental permitting alone can consume 5 to 7 years in Western jurisdictions before a single ton of ore is moved. So when China restricted exports, the market looked around for replacement supply and found almost nothing. The price did not double because of panic. The price doubled because of arithmetic. Available supply dropped dramatically. Demand did not. Price is the only mechanism that can balance that equation. And it balanced it at 100% higher. Now here is why I am talking about this on a channel that focuses on precious metals and silver analysis. Because tungsten is not an isolated case. It is a template. And if you understand the template, you can apply it across the entire critical minerals landscape to identify where similar dynamics are building. The template has 3 components. Component 1 is supply concentration. A small number of countries, or in tungsten's case, essentially one country, controls the majority of global production and refining. Component 2 is strategic importance. The metal is essential for defense, technology, energy, or infrastructure applications where substitution is difficult or impossible. Component 3 is the policy trigger, a government decision, whether it is an export ban, a quota, a licensing requirement, or a silent directive to prioritize domestic consumption that suddenly restricts the flow of material to global markets. When all 3 components align, the result is what we just saw in tungsten. Rapid, violent repricing that catches the majority of market participants completely off guard. And the reason it catches them off guard is that markets are extraordinarily bad at pricing tail risks. They are good at pricing the world as it is today. They are terrible at pricing the world as it might be tomorrow. And in a world where geopolitical fragmentation is accelerating, where resource nationalism is becoming the default rather than the exception, where trust between major trading blocs is eroding year after year, the probability of these policy triggers is not declining. It is increasing. So let us apply the template. Where else do we see supply concentration, strategic importance, and potential policy triggers converging? Silver. China is the world's largest silver consumer and is deeply embedded in refining and processing. A significant portion of global silver flows through Chinese infrastructure before reaching end users in the West. Silver is critical for solar energy, electronics, electric vehicles, medical devices, military systems, and advanced computing. And we have already seen reports of potential export tightening. Silver does not have 80% concentration like tungsten. The supply chain is more diversified, but the refining bottleneck is real, and the demand profile is rigid. A policy shift from China regarding silver exports, even a partial one, would create exactly the kind of supply shock that the paper market is not pricing in. Graphite. Essential for battery anodes. China dominates global production and processing. Export controls were introduced targeting specific grades of graphite used in lithium-ion batteries. The battery supply chain scrambled to find alternatives. Do you see the pattern? This is not a one-off event. This is not an isolated decision made in response to a specific dispute. This is a strategy, a deliberate, systematic, documented approach to leveraging supply dominance as a geopolitical tool. Each restriction follows the same playbook. First, administrative adjustments, licensing requirements, quality inspections that slow down exports without formally banning them. Then, if geopolitical conditions warrant it, explicit quotas or outright bans. And every time it happens, the same sequence plays out. Markets are surprised, even though the pattern is now well established. Prices spike because alternative supply does not exist at scale. Western governments announce emergency plans to develop domestic alternatives. Mining companies dust off feasibility studies that have been sitting on shelves for years. Politicians give speeches about supply chain resilience. Those plans take years to materialize. Environmental reviews, community consultations, engineering studies, financing rounds, construction timelines. A new mine in a Western jurisdiction is a 7 to 15-year project from conception to production. And in the meantime, the structural scarcity persists. The higher prices become the new normal. And the market learns painfully that decades of outsourcing cannot be reversed with a press conference. Now let me connect this directly to what it means for silver and gold investors, because this is where the regime change becomes personal for your portfolio. For decades, the global economy operated on a principle I would call efficiency over security. Supply chains were optimized for cost. Materials flowed freely across borders. Just-in-time delivery was the gold standard. And the assumption was that markets would always be open, that trade would always be free, and that geopolitical tensions would never be severe enough to disrupt the flow of critical materials. That era is over. We are now in a regime I would call security over efficiency. Countries are stockpiling. They are reshoring. They are building strategic reserves. They are restricting exports of materials they consider vital to national interests. They are willing to pay more, operate less efficiently, and accept higher costs in exchange for supply certainty. And this regime shift has profound implications for metals pricing across the board, because in the old regime, the price of a metal was determined primarily by supply and demand in a free, open, globalized market. Miners produced, consumers bought, price found equilibrium. If supply got tight, new projects got funded, and within a few years the market rebalanced. It was elegant, it was predictable, it worked. In the new regime, the price of a metal is increasingly determined by supply and demand in a fragmented market where access itself has become a variable. It is not enough to have dollars. You need access. You need relationships with producers who are allowed to sell to you. You need contracts with refiners who are not subject to export controls. You need logistics chains that do not run through jurisdictions that might close the door tomorrow. And when access becomes scarce, the premium you pay is not just for the metal, it is for the certainty of delivery. It is for the guarantee that the bar will actually arrive at your warehouse, your factory, your vault. That certainty premium did not exist 10 years ago. It barely existed 5 years ago. Today it is one of the most important components of metals pricing, and it is only going to grow as geopolitical fragmentation deepens. This is why Project Vault matters. This is why the United States government announcing a strategic minerals purchasing program is not just a policy footnote. It is a signal. A signal that the most powerful economy on Earth has recognized that the old model is broken. That relying on geopolitical competitors for critical materials is a vulnerability, not a strategy. And when a government starts buying with real money, not just talking on television, not just issuing press releases, but writing checks and filling warehouses, that is a vote of confidence in scarcity that should get your attention. Now here is the nuance that separates mature analysis from hopium. $12 billion does not single-handedly move a trillion-dollar market. Government buying alone does not explain an entire price leg in gold or silver. The mature read is not that the government will carry everything higher by itself. The mature read is that this kind of official buying shifts the psychological floor. It tells private capital that the smart money, the sovereign money, the national security money is positioning for higher prices and reduced availability. And that encourages front-running by institutional and private buyers who see the direction of travel and want to position before the crowd arrives. Price is narrative. Flow is reality. Whoever pays cash and stockpiles is voting with real capital. Whoever talks on television is competing for expectations. And when actions and words diverge, I follow actions every single time. Now let me address the question I know some of you are thinking. If governments become strategic buyers, do they also become price makers who cap the upside? It is a fair question, and the honest answer is layered. In the very short term, yes, governments can influence rules and narrative. They can raise margin requirements. They can issue statements designed to cool sentiment. They can use regulatory tools to manage market behavior. But in the medium term, none of that matters. What matters is scarcity versus replenishment. If the marginal cost of bringing new supply online rises, and it is rising across virtually every metal because of permitting delays, environmental requirements, declining ore grades, and infrastructure costs. Then the equilibrium price rises with it. That is not opinion. That is commodity cycle math. Communication does not create metal out of thin air. Press conferences do not fill vaults. And regulatory tools work on paper markets, not on the physical reality of how much metal exists and where it is located. So what should you be tracking? Here is the framework I use, adapted for a world where resource nationalism is the defining trend. Signal 1. Inventory levels and physical availability. Are exchange inventories draining or rebuilding? Are delivery times extending or normalizing? If inventories fall persistently and delivery tightens across multiple metals simultaneously, the structural thesis for higher prices gains strength. This is the most fundamental signal. Everything else is secondary. Signal 2. Physical premiums versus screen price. When physical metal consistently trades at a premium to the futures price, it tells you that the screen quote is not reflecting real-world scarcity. A persistent premium is friction made visible. It is the market confessing that the paper price is too low to clear physical demand. Signal 3. Curve structure and carry costs. Watch whether futures curves are in contango or backwardation. A shift from contango to backwardation is a shift from comfort to urgency. It means the market wants metal now, not later. And in a world of export bans and supply restrictions, that urgency has a structural component that does not fade with a single headline. Signal 4. Capital flows into ETFs and miners relative to metal prices. If metal prices rise but mining stocks diverge negatively for extended periods, that divergence is either a buying opportunity or a warning about rally quality. If metal prices rise and physical ETFs see consistent inflows while paper ETFs see outflows, that tells you the character of buying is shifting toward physical conviction. Signal 5. Government policy backed by real capital. Not press releases, not speeches, not promises for next year's budget. Actual purchasing programs with allocated funds and delivery timelines. When governments move from talking about supply security to spending on supply security, the signal is as clear as it gets. If 3 out of 5 of these signals align, you have context. If 4 or 5 align, you have regime confirmation. And right now, as I record this, I count at least 3 aligning across the critical minerals complex. Tungsten doubling in 90 days is not an anomaly. It is a preview. It is what happens when decades of complacency meet a single policy decision in a concentrated market. And the lesson it teaches is simple but uncomfortable. The world has built its technological future on metals it does not control. Solar panels need silver. Batteries need graphite and lithium. Semiconductors need gallium and germanium. Defense systems need tungsten and rare earths. Electric vehicles need copper and cobalt. And for most of these metals, the supply chain runs through one country that has demonstrated repeatedly its willingness to use supply as leverage. But I need to give you the grown-up part of this conversation, because understanding the regime change does not protect you from the volatility that comes with it. The metals sector can drop 20 to 30% even within a powerful structural uptrend. We saw it with mining stocks in the recent sell-off. We see it repeatedly throughout commodity bull markets. And the reason is straightforward. Leveraged participants get flushed. Algorithms accelerate the selling. Margin calls force liquidation of good positions alongside bad ones. Month-end rebalancing creates violent candles that have nothing to do with fundamentals. And when the selling is over, the structural thesis is exactly where it was before. The inventories are still draining. The export bans are still in place. The demand is still growing. Nothing changed except the price and the emotional state of the participants. This is why position sizing matters more than thesis quality. You can be completely right about the direction and still get destroyed if you cannot withstand the drawdown. If you are running a position you cannot carry through a 30% correction, you will sell the bottom. You will sell at the worst possible moment, and then you will watch the recovery happen without you. That is not the market betraying you. That is poor risk management betraying you. So the practical rule is this: size your exposure so that a significant drawdown is painful but survivable. Avoid emotional leverage. Avoid financial leverage unless you have deep experience managing it, and treat volatility as the cost of admission, not as evidence that the thesis has failed. The old regime priced metals as if supply would always be available. The new regime prices metals as if supply might not be. And that difference, that shift from assumed abundance to priced scarcity, is one of the most powerful investment themes of this decade. Not because of speculation, not because of hype, not because someone on the internet told you to buy, because of the physics of supply concentration meeting the politics of national security in a fragmenting world. because of the observable, documented, measurable reality that the metals powering modern civilization are controlled by a small number of actors who have shown they are willing to use that control as leverage. Tungsten was the canary. It sang at 100% in 90 days, and its song was not unique. It was the same song that rare earths sang in 2010, the same song that gallium and germanium began singing in 2023, the same song that graphite is humming right now. The question for silver, for gold, for copper, for every critical metal in your portfolio is not whether the same dynamics apply. They do. The underlying architecture of concentration, strategic importance, and policy vulnerability exists across the entire complex. The question is timing, and timing, as tungsten just demonstrated with brutal clarity, has a way of arriving much faster than anyone is ready for. One policy decision, 90 days, 100%. That is not a chart pattern. That is a new reality announcing itself. Thank you for watching until the end. I'm truly impressed by the quality of comments on the previous videos. The depth of knowledge in this community is remarkable. Thank you all for the topic suggestions. Many are already in development, and I'll be publishing them over the next few days. In the meantime, please like, share, and subscribe if you think we've earned it.